Let's get going. I trust everyone can hear me fine. So welcome to our second update of the year. So usually you see us at the BCI presentations or other conferences that we attend. We host two of these sessions per annum. We had one at the start of the year, so this is the half yearly update that we do. The next one you'll hear from us is in January. This one's a little bit different to the format that we usually do. It's usually either myself or Roger that does the presentation. I've asked Laing to join us this time. So both him and I will be doing the presentation. He's got quite an interesting piece on artificial intelligence that he'll be discussing later. I think it's very worth listening closely to that. And he's really our offshore expert and is joining us out of the UK. So I'm going to get going. So just the first, just an update on the business. So by now, I'm sure you're all familiar that we are a retail-only asset manager. We've got just over 11 billion of AUM currently. Over the half-year period, the Flexible Fund was nominated for an innate award in the SA multi-asset category. I'll touch on this now, but we also bolstered the team. We've added a new member to the investment team that started at the start of this month, James Price. He's joining us from Standard Bank or Melville Douglas. And then Vasti Krania is joining us on the client services side. And then I guess the other kind of change or ongoing improvement that we're implementing is that we've started implementing AI and integrating that into our research process. And we're happy to take a bit of questions on that later. So just the team, everyone you'll be familiar with. I've just highlighted the two new members that have joined us, James Price and Vasti. And then top middle of the screen, Laing Walker, that's also on the call joining us from the UK. Really deals with the offshore side of things. So what's Centaur's edge? I think it's performance culture. We mention this every time we speak, but we think we've got very competitive benchmarks. We don't use the average funds in the category. Our benchmarks typically beat the average funds. By way of example, if you look at the balance funds benchmark over a 10-year period, it's probably a top decile performer if that were a fund. And then we've got various processes that we follow. I'm not going to go through the investment philosophy today, but we do kind of dynamic value creation. The Centaur way is really the process that we follow when we look at businesses and we do research. And I think quite important, the last bullet point that I highlighted is that we evolved to a rapidly changing world. And I think in terms of AI, that's probably more applicable now. Because really, if you look at, Centaur's been around for a 25-year period, and you go through various market cycles, and what might have worked 25 years ago or even 10 years ago might not work today. So we're constantly tailoring and trying to improve the investment process and the way we do things. Just an update on the performance. So this is the Flexible Fund. The past 1 year, and it's really been a year-to-date story. The fund, both flexible, balanced, and SA equity, have been lagging quite a bit. I'll touch on the detail around that a bit later. But 3 years, 5 years, 10-year funds are still doing well above the benchmarks. And over a 10-year period, the Flexible Fund is still the number 2 fund in its category. 5-year period, number 5, over 55 funds in the category. And then on the right-hand side is just the number of awards that it's won over history. And really just, I'm sure you're familiar with this, but a flexible fund is typically for an investor who's got discretionary funds that they would like to allocate. I kind of like to think of a flexible fund as a kind of like a hybrid long-only type of a hedge fund. So really, I think a kind of a purist form of an investment vehicle. Then we've got the balance fund. So that's really, Regulation 28 compliant. So typically runs lower risk than what a flexible fund would run, and more for kind of retirement type of money. Also tough 1 year, similar reasons to the flex fund that we'll touch on, but over 3, 5, and 10 years, still very respectable performance. Sixth best balance fund in the country over a 10-year period, and it's also in a much larger category, over 100 funds or balance funds that have been running for that 10-year period. The SA Equity Fund, and this is really where you see the performance kind of pronounced. Had a very good year last year, was the #1 fund in its category. Year to date, really been impacted by a few factors. It's mainly gold. If you think of kind of like a cap Schwix kind of a benchmark, gold's really been about a 10% drag for this fund year to date, as it hasn't owned any gold exposure. Then if we just move on to kind of the contributors and the detractors of the flexible fund. So Prosus, we've been overweight for some time. Around 2 years ago, we turned a lot more positive on China, kind of in general. We saw, a bit of a regime change, a change in the way that, management were running their businesses and returning capital to shareholders. And we also acknowledged the change in management at a Prosus level as well. So the change I'm referring to Tencent. So that one's done quite well for us. We've got a physical platinum ETF that we bought in the flexible fund. That's also done quite well. It's up 40% in the first half. We do have some mining exposure. We've been trading in and out of Northam and Valterra, which have also added to kind of the PGM returns, I guess, in the funds. And then Artsurance has been a long time hold in the fund. That's done quite well in the first half. Momentum. African Rainbow Minerals has exposure to Harmony and the PGM sector, so would have benefited from the run in those two. The detractors, Truworths is one that we have been topping up at current levels. Had a very good run last year. What we found is year to date, a lot of liquidity's been kind of sucked out of the SA Inc. names, the retailers, banks specifically, and a lot of capital's moved towards specific corners of the market. So really the only game in town year to date has been kind of the dual listed RAND hedges. So, think BTI, AB InBev, and then it's really been the precious metals that have done well. But Truworths we still like. We've upped that holding. Aspen has been very disappointing. I'm not going to go through all the details there, but essentially Aspen fell in the first half when a contract at their French facility with Moderna has been cancelled. We have topped up Aspen a bit. They still own that manufacturing capacity. It's really just about timing and whether or when they're able to fill that capacity again. At the moment, the market really has lost all kind of faith in Aspen, but we think at these levels, it is very attractive. Trip.com is a business that we've also been adding to. Really what's happening there is that they're reinvesting into the business, specifically their outside of China kind of travel platform, and that's caused earnings this year to be flat, which the market is looking kind of negatively at, but we think that's actually quite positive. They're taking a longer term view, and we're still very happy with Trip.com. Laing will touch on that a bit later as well. And then Wilson Bailey had a very good last year. It has pulled back a bit, and then Philips not that material. But really it's been what the funds haven't owned versus what they have owned that's impacted the relative performance year to date. Then just in terms of attribution, so here you can really see kind of where it's pronounced. If you look at the local equity portion, 4.2% versus the benchmark 16%, and basically 10% of that is coming from the gold sector. I think also just bear in mind last year we did have very good years in all three of the funds. And then the offshore equity component is keeping up. Laing will touch a bit later on how we kind of looking forward, where we making asset allocation changes, and where we currently seeing the opportunities. So I thought I would just highlight the performance in context. So what we've done here is illustrated the flexible fund, essentially since inception, the periods where you have the shaded area kind of above the zero line. Those are periods over a rolling 1 year period where the flexible fund has outperformed, and then the shaded areas below the zero is where the flexible fund has underperformed. So in a 20-year period, this 1 year period is the fourth time over a 20-year period where the fund has underperformed. Just highlighting 76% of the time the fund does tend to outperform. The big detractor here for the flexible fund is the no gold exposure. It's been approximately a 4% drag if you look just at the flexible fund over the 1 year period. But I think what's quite important, and I've written it in bold there with an exclamation mark, it's more kind of written it like that for ourselves, that we have been here before, and we are sticking to playing our own game. Really, reason we haven't owned gold is they aren't typically businesses that we would normally invest in. We don't think that through the cycle that they are value creators. I think they are more kind of trading type of stocks. So just an update on the economic outlook. I don't think much has changed here. So we're still expecting lower interest rates. The SARB's meeting at the end of the month, we do expect 25 basis point rate cut, which would take the cumulative rate cut from the top to the bottom now 150 basis points. We'll see if there's more to come. There is a lot of talk about changing the inflation target to 3%, which might hamper further rate cuts. We all know, load shedding, that's kind of in the base, not really getting that anymore. And then structural reforms by Operation Vulindlela are ongoing, but they are at a painstakingly slow pace. The negatives are the municipalities. I mentioned here about water infrastructure as well. The interest rates we think are still way too high, even though we've had 150 basis points of cuts. And then the GNU relationships do seem to be deteriorating. That being said, we still think that the economy can grow at 1 to 2% real GDP over the next few years. This year, it looks like the market's looking for around 1%, and then in later years, 1.5% per annum. So I don't think we are too dissimilar to that. And then given the valuation of SA equities and where we are, we still think that 15% return per annum is possible over the next 3 years, and I'll give you some context to that now. One area where we think there's a lot of opportunity at the moment is in the SA banking sector. So it's a little bit of maybe a complicated picture here, but basically this is FirstRand's price to book, or it's you could think of it as like a PE, but for banks. And that's just a measure of valuation versus the 10-year bond yield. So really, banks are valued off of where the 10-year bond yield is trading. And if you look at that blue line there, that's kind of recent history, where when you reach that kind of level, that's exceptional value, relative to where our government bonds are trading. That's exceptional value for the banks. So we think FirstRand and both apps are offering exceptional value at the moment. It's part of that story that I mentioned earlier, where a lot of capital has been kind of sucked out of SA Inc. into specific corners of the market. We've also had foreigners selling, and we think that's created an opportunity. So we have upweighted the banking exposure across the funds. We're also seeing loan growth starting to pick up. Credit costs are easing, and in terms of FirstRand, we still think 10% earnings growth is possible. there's a re-rating, which is evidenced by this chart, also possible, and you're getting around a 7-8% dividend yield. So, we think 20% plus kind of return per annum over the next 3 years from FirstRand, and both ABSA is likely. Then, we show this slide quite often. I'm sure you're familiar with it by now, but this is really just kind of a model that we look at for interest rates. And as I mentioned earlier, if we do get the 25 basis point rate cut at the end of this month, then that is typically a signal to go overweight SA equity. No, the consumers can't really spend confidence. The only thing that they really spend is money in their pocket, and lower interest rates do lead to higher disposable income in consumers' pockets, and that 150 basis points is typically when we start seeing guys spend. You do see some sign of it already. The retailers kind of like post-period are reporting 10% kind of top line growth. You're seeing a bit of it in the vehicle sales as well. So there does seem to be some underlying spend going on at the moment. I'm going to hand over to Laing. He's just going to take us through this artificial intelligence section. Laing?
Yeah, thanks. Morning, everybody. Excuse me for being a little bit giddy over the next few slides, but at Centaur, we're very passionate about thematic investing. We've invested in some of the major ones like cloud, electric vehicles, etc. AI, artificial intelligence, I'm sure no one needs an introduction to this, but the next few slides, I'm going to take you through how we're conceptualizing it, how we're thinking about the big picture for AI. So obviously right now, everyone's trying to figure out what's it going to look like, which industries are going to be disrupted, how's it going to be monetized, who's going to be the laggard, who's going to be the leader. But first, it's important to go back and look at historic tech cycles. So if you look 10, 15 years ago, we all remember buying our Microsoft Office license, and you'd pay quite a lot for it up front. You'd keep it for a few years until maybe the next product cycle, or you might just keep it indefinitely. And then cloud came along and we got access via the internet. And it was very transformative, right? It was lower cost for us. It was higher access for us, being the consumer. The software producers like Microsoft were able to monetize it better. It was transformative, and it led to this SaaS model, this software as a service, as we know. And it was very transformative. But in this AI paradigm that we've entered, we think that this has the potential to sort of turn on its head. And this new SaaS model emerges, this idea of service as a software. And what I'm talking about here is, really agentic AI, which is a very buzzy coin sort of phrase at the moment, but it's this idea that AI starts taking on the roles of the human and starts performing human tasks. So to give you an example, maybe if you go to your local hospital, you won't be triaged by a nurse or a doctor. You'll actually be vetted by this sort of advanced AI bot, and it might be able to more accurately and more quickly diagnose you. And maybe instead of speaking to a customer service representative, you'll be speaking to an AI bot, and you won't even know the difference. So this AI could go after, what we think is about 1 billion knowledge workers and disrupt not just this $1 trillion software industry, but the $10 trillion services industry globally. So it could be wildly disruptive. Obviously, where, when, how, it's still too early to tell. For us right now, we're thinking about it, maybe the rudimentary lower tier workers get disrupted over the next 5 years, but these widespread systemic economic changes could play out over the next few decades. And so what I'm really trying to highlight is that, if you look at how well the US equity market performed, given this sort of burgeoning growth in the $1 trillion software market, we're talking about a $10 trillion services market that could be disrupted. The next slide, I'm going to try and help us sort of conceptualize how this could play out across industries. So where this will work best in our minds is you look at industries where, labor is quite expensive, processes are quite repetitive, the tasks are repetitive, there's a lot of data, and it's a bit inefficient. So it's a perfect sort of breeding ground for these AI models to learn and disrupt. And what we're seeing so far is two paths that have emerged. So first, you've got these companies, probably the leaders, that'll be able to self-disrupt. So they'll be able to internalize the AI, they'll be able to get ahead of the disruption, they could become an AI enabler themselves. So a great example of this would be Booking.com, which I'm sure we're all familiar with. You know, we use it to book all sort of items of travel. It's our hotel, it's our flights, it's our taxis. And right now, we do all the searching, we do, you know, the booking, the comparisons, putting the whole trip together. But in the future, you go into Booking.com, you'd say, book me a trip to Thailand for 2 weeks for, you know, $3,000. You know what I like, where I like to dine, what I like to do, and it does it all for you. And so the AI becomes this travel agent in software form. The second path is where entire industries, you know, their workforces could be displaced. So if you look at the chart, you know, you've got stuff like AI Harvey, which is going after this $1 trillion legal market and questioning whether the paralegal role actually even needs to exist, or the AI factory, which is going after this $1.2 trillion software engineering market where, you know, lower value programming could be done by an AI bot faster, cheaper, and could replace a large part, you know, of this engineering space. So you can see how wildly transformative this could be, but equally how disruptive it could be and how many question marks it brings. So I think importantly now our job is to identify which of our companies could actually be disrupted, which of our companies could land up being an AI enabler and a disruptor, and looking out for these new emerging business models. We have to, you know, we can't be asleep at the wheel here. We have to identify that this mass scale disruption is coming. So how we're kind of thinking about how this might unfold, particularly looking at previous tech adoption cycles. Historically, when a new technology comes along, you have these 5 stages. So you have the first and second stages where it's these kind of early adopters, tech enthusiasts, they all pile in because they're excited about this new technology, but the product, you know, sort of standard isn't really established. The use case is a bit murky. There's no real like ROI. And then once it starts to get figured out and people understand the product better and it's been through multiple iterations and it becomes sort of false, right? The adoption is false and you get this mass adoption. And eventually you get the last stage, which is the skeptics, you know, the Luddites, they don't want to adopt the technology, but eventually they just have to, everyone's using it. You can see from these 5 stages, we're clearly in the early innings. We're 3 years into this AI cycle. Historically, it's taken about 6 to 8 years for a new technology to actually hit its stride. And so it's early. It's early for us to be saying who's going to be the leader, who's going to be the laggard. And I think that's been a recurrent theme throughout my little seminar here. But a good example, if you look at the chart, is Google. So everyone thought Google was this gatekeeper of the internet. No one could disrupt search. But if you look at the growth in, you know, Google page views, which is a good indicator of interest and engagement with Google search, growth has fallen off a cliff since ChatGPT came into the picture 2 years ago. So Google went from this gatekeeper to being a question mark. So looking historically against these tech cycles, where we are now, these early innings, we think it's the best sort of risk-adjusted bet to be in these companies that are providing the picks and shovels. So it'd be difficult for AI to progress without, you know, AI hardware, which is Dell. It'll be difficult for it to progress without cloud, which is Microsoft. And then we're also investing in these rapid AI adopters like Trip.com, where they've already internalized it. They've been doing it for years. This isn't new to them. And they've really focused on both sides of the platform network, the supply side, the demand side. So what I've tried to show you here is this is going to be huge. It's going to be transformative, but it's also going to be very disruptive. And we're still early in the game. I'd say large pockets of this AI trade are in the bubble. You know, many AI exposures we're looking at, we've got a lot of companies we're monitoring. They're actually very good value because the market hasn't cottoned on to its AI potential yet. And we're trying to put together this entire sort of AI mosaic. But to reiterate, it's big, it's coming, but it is early in the game, and picking the winners will be key. Just to highlight our investment strategy, I think we all expect continued volatility. Trump's tariffs, we're still trying to see how that's going to play out. There's this taco trade where Trump always chickens out, but he's also kind of showed that, that's not the case. And some tariffs have been put back on the menu. That could have widespread implications for the global economy. I think, he's also sort of sparring with the Fed, and it's, difficult to understand which direction, rate cuts could take. And you've got this AI theme, which is just huge and disruptive. And I think that, these three forces are really creating a lot of volatility, but which for us is great, provides a lot of opportunities, particularly offshore. I think South Africa, we still see good returns, good risk reward. I think Nick highlighted it, particularly the banks trading as if, recession's coming, but actually all leading indicators are looking, pretty compelling. Again, AI, we've got this watch list of companies. We're tracking these key indicating points very closely. We're continuously trying to understand who's being disrupted, who could be the disruptor. And as we gain more comfort and build up an edge, which is very important for us, to be able to bet against the price action, we have to have some superior insight. As we build up our edge and our capabilities in this AI trade, we'll increase our exposure there. So look for that offshore. And then just in general, we've been upweighting our offshore exposure, particularly taking advantage of, the tariff hits in April. And just in terms of the fund positioning, the balance fund, no major changes. Government bonds were still roughly, unchanged. We took some profits in certain SA counters, like Tiger Brands and Roynet, which were sold at exceptional levels. Offshore, as I say, we've been upweighting it. That was a general upweighting during the tariffs. Some of our cyclical exposures that were bought at sort of trough levels. And then also stocks that were just sold unnecessarily during the tariff hit. For the flexible fund, really we've been deploying our offshore cash. Again, similar story. It was widespread upping our equity content. Our benchmark in general for equities is 80%. We've gone up to 83. And really offshore, it was taking advantage of that tariff hit, buying companies that were only affected on a second round basis, whose growth trajectory is actually largely similar or unchanged. And generally just upping equity content into what we see as a good opportunity sort of environment. Then the equity, top 5 holdings for the flexible fund. Process, I'm sure many of you that have been following us for many years that have been clients. We never owned Process for 4 years, roughly. And what had happened was really, we don't take views, strong views on the macro, but China had just become this land grab. No one was focused on profitability. It was all about market share at everyone else's expense. And shareholders were just absolute minorities. And what we've seen is this change. We've seen companies become interested in unlocking value for shareholders. They've been optimizing costs, improving margins. We've seen a return to growth and rational growth. And Tencent is the bellwether of China. It's the operating system that's unchanged. It's been pivoting to AI. It could be one of the key AI enablers of China. And so Tencent is back to this sort of mid-teens growth earnings trajectory. And with Process, it's finally becoming a sort of it's gone from a 10-cent minus to a 10-cent plus story, where Process is doing the right things finally. They're cleaning up the portfolio. The new CEOs come in, and they're doing a very large share buyback, which just adds to the return of Tencent. So we still see 15-20% returns for Process over the next several years. That's why it's our biggest position. Nick highlighted the banks. Again, prices if we're seeing a recession, but by all indications, offering very good value over the next 3 years. Truist have actually been topping up on. SA Inc. just had, a bit of weakness this year. Truist got caught in the headlights, and really we still like the story. We still like the capital allocation, the stewardship there. Just turn to the next slide. I think what I'd like to highlight here is, Platinum. Platinum has been quite an exciting story with, these above ground stockpiles, which no one really had a handle on. We sort of gained a little bit more clarity around this. Those stockpiles have been being reduced. This, supply demand deficit continues to grow. And, you've seen increased demand. You've seen a bit of a rotation into platinum. You've seen high jewelry demand. And we could also be seeing somewhat of a rotation from gold into platinum. So that's worked well for us. I think two stocks we're still excited about is Dell and Delivery Heroes. With Dell, again, it's at the center of this AI trade. It's the center of cloud. And really, this business has gone from being your standard PC maker to being an enterprise play. They are one of the preferred, partners to NVIDIA for these AI servers. They are probably, the best, them and Supermicro, at being able to customize these servers. They're quickest to market for their customers. And so we don't see a better player that can actually provide these AI servers at scale, at speed, at the right price, like Dell can. And again, doing all the right things, large buybacks, focusing on cost optimization and sharing those costs with the customer. So we see a good environment for Dell to perform. You've also got all other areas of the business in an upcycle. And so it seems quite de-risked. This volatility this year, Trump's caused a lot of volatility offshore. So Dell went from roughly $140, $145 all the way down to 70 on one of these Trump tariffs. And we were actually buying close to the lows. It's already back up to near $130. Delivery Hero, we actually bought a trading position. We took a trading position last year. It was quite a quick sort of 50% return we made. We subsequently exited as they listed Talabat. And what you find with the share is it's highly susceptible to news flow. So what's been going on in the background is this sort of hidden compounding. Revenue and EBITDA has been growing rapidly. Revenue sort of over 20%, EBITDA over 50%. And news flow can really throw the story off kilter. And so last year we traded it. This year it's pulled back again, despite the fact that the balance sheet has improved, that Talabat is listed, that Middle Eastern operations are growing rapidly. Korea, we're seeing a new CEO installed. We're seeing strong initiatives being taken. So we've bought into this weakness and we're sort of playing it again. And it really is a business that is growing stronger on a net basis. One that we're still excited about.
Okay, thanks, Laing. Then just to conclude, it's been a tough first half performance for us. It's really been about what we haven't owned. But we've been here before, and we're focusing on playing our own game. We still think there's scope for SA Inc. to perform. I spoke about the banks, particularly, we think are a good opportunity. We've gone overweight there, and we are continuing to buy them. We continuing to find and explore exciting offshore ideas and themes, specifically AI. We've got a whole list of businesses that we're currently working through. And a few that we kind of in the final stages of potentially implementing. And then we still remain confident that Centaur funds will outperform over the medium term. So that wraps up the presentation part of things. I'm just going to stop sharing my screen. So I see there's a couple of questions that have come through. So if you haven't submitted a question, you're welcome to send it through. We'll deal with as many as what we can. And then if we don't get your question, then what we'll do is we'll get a list of them and email you afterwards. But let me just start off. So Adam, hi Adam. So to what extent, so Laing, this one will be for you. To what extent is your view on AI not in the price? How are you able to get an edge or gain superior insight with respect to such a significant theme, which the market seems well aware of? I think maybe, okay, I mean, you can answer that, but maybe just answer it, in the context of Dell. Maybe like versus NVIDIA is quite a good kind of example of it.
Yeah, I mean, that's a great question. I think that it's helpful to put things into camps. So we look at it as, disrupted, AI adopter, and AI enabler. I think that the market is well aware of the AI enablers. I think that what's helped us is with, so if you look at something like NVIDIA, it's trading at, 35 times earnings. Everyone knows that NVIDIA is driving this AI charge. It's the key AI enabler. But if you look at other counters that actually have similar exposure, like Dell, you're getting the same exposure, but you're getting it at 13 times earnings, not at plus 35 times earnings. It's the same as something like a TSMC, because the geopolitical risk, you're getting the same AI exposure, but at 16 times earnings, whereas its counterpart like ASML might be trading at 30 times earnings. So we find the same exposure, but a better risk-adjusted way of playing it. And so many of these, there's many sort of companies that are flying under the radar that have similar, AI exposure. Again, with Dell is actually the key provider to CoreWeave. All of CoreWeave's compute is actually being powered by Dell, and yet CoreWeave is up multiple times this year. Dell's up 10% year to date. And eventually we find that, the narrative does catch up with the company. And then how do we build our edge? I mean, this is what I guess everyone is still trying to figure out. AI is very complicated. So, and again, there's multiple ways of benefiting from this AI trade. So we're building up our edge by, you have to speak to everybody in the industry. You have to form this mosaic. And it's important, not just speak to management. It's important to speak to everyone in the supply chain, the employees, current, both ex-employees. And you start to put together this kind of mosaic about what's happening on the ground, because a lot of this is noise. A lot of it is sort of, sell side, sort of punting their book. We're trying to build this bottom up, on the ground perspective that sort of paints the harsh reality of what's going on. And that's actually led to us sort of reassessing our own holdings. There's been certain stocks that we feel, maybe they're actually open to disruption. And subsequently as well, we've looked at some of our own stocks that aren't tied to the AI theme, but also look at something like Philips. It's not known for it at all, but in radiology, they've made huge advances. You've got these MRI, CT scanners, all of these diagnostic imaging tools that have now got AI embedded into them. It will dramatically improve productivity for the radiologist, where the radiologist doesn't have to spend, a third to half their time on admin. The AI will be doing that. The AI will also be reading the scans, outputting the diagnosis, probably faster and more accurately than a radiologist. So as I say, like there's more than one way to play this AI theme. It's not just following the enablers. It's also looking at other companies that might adopt, that might self-disrupt. So we're still early innings. That was a point of our presentation. It's difficult to tell you right now who's the leader, who's the laggard, but we are slowly putting the picture together. We'll sort of upweight exposure as we gain more of an edge. Yeah, Nick, if you want to add anything to that.
Yeah, like maybe what I'll just add is, so Adam, I guess it's similar to like the whole .com thing. It's very difficult to know, exactly who the winners will be, and a lot of businesses are on, frothy multiples. So that's to the point, what you're saying, that it's price in. But that slide that Laing had up with the $10 trillion opportunity, there's absolutely no way that that's being priced in everywhere. So it's really going to be about picking which ones are, kind of the winners and which ones aren't. Laing had the point earlier where he said, AI is maybe in a bubble, and kind of like the point of that is making a number up here. But like, let's say you have 1,000 businesses in AI that are all being priced or are pricing in some form of AI. If there's only 20 businesses left, the 980 of those won't exist. So that's kind of the risk in the whole thing. So it's really about figuring out who benefits one, no matter what, or who's kind of busy building an edge in AI. There's one company that we're looking at the moment where the market's kind of saying, AI is going to completely disrupt this business. But if you look at how they're actually performing, the business is growing, and in the numbers there's absolutely no evidence of AI influencing at all. So that we think that's a potential opportunity, and we think it might actually benefit from it. But we can carry on for a long time about this.
I think one last point that I'd like to make is what happens with these tech cycles is the markets always overestimate things over the short term, and they always underestimate it over the long term. And so even like AI enablers now, as you said, Nick, like, paying tribute to the .com bubble, these stocks could, they could halve in the near future, because expectations just get built up too much. And then that's when we could come in and actually buy them at depressed prices. because it's not just about, understanding who's winning, who's losing. There's also an AI tech cycle that will develop, and playing that cycle, selling at the peaks, buying at the troughs. And I think we've got a reasonably good handle on that because of our assessment of prior tech cycles. So that's also the way of playing it. You just wait for the enablers to come on sale, which they always do. Because as I say, we overestimate short term, we underestimate long term.
Okay, then question from Ian. Do you think data centers, provided you judge them to be reasonably priced, are a less risky bet on benefiting from the growth and demand for AI services? Laing, do you want to answer that?
Yeah, I'm just thinking, because we have looked at it. Obviously, there's many ways to chop up the AI trade. With the data centers, I think we don't like how capital intensive the businesses are. Simplistically, we own Microsoft. That's become more capital intensive because, they actually own the data centers. But, the incremental return on capital there is still, exceptional. It's value additive. But, actually just these pure data center players themselves, we find it's too capital intensive. It's difficult to see where the real competitive advantage will lie down the road. So for us, I think now it's a part of the AI trade that we're standing back and just watching.
Okay, then could you expand on how you're incorporating AI into your investment process and research? So, I'll just briefly touch on it. So, for now, what we're finding is that it's speeding up the research process significantly. We used to have to go through 200-page integrated reports. What we're doing is we're developing a lot of prompts. So in these language models, with specific things that we look at as it relates to different industries. So you basically feed the documents into the language model. You've got your standard set of prompts that you ask, and then you kind of get a quick summarized version of things. You need to be careful of it. Sometimes the language models don't go through every single page, so you do use it with a bit of caution. And then typically when we look at new businesses or kind of like start an investment process, we've got specific questions that we ask ourselves, whether it relates to the competitive advantage of the business, the industry, and we've created prompt templates with that as well that we're feeding into it. So it's just also speeding up the screening of businesses that we look at. Then there are other things that we're also exploring. There's financial models that we update. It can be quite a manual process to do that. We're looking at systems where basically AI automatically updates your own proprietary models, for you. Like investment meetings that we have where someone used to have to sit and manually make notes. Now we've got it summarized for us. So that's just examples of it, but it's like we're continuing to expand on it. We've got a dedicated person in the investment team that's responsible for implementing those things. Do you have anything to add, Laing?
Yeah, I'd say it's really akin to that example I gave earlier with the radiologist, where instead of the radiologist spending most of their time on admin, they can now actually spend more time with the patients and on the scans themselves. So I think with us, a lot of the sort of lower tier tasks we can now outsource to AI, and so we can end up spending more of our time on the things that really matter instead of being bogged down by these sort of lower value tasks. I think so. It's a very good productivity tool for us.
Okay, the next one's from Martin. Hi, Martin. So it's for you, Laing, but I can also answer it. But can you talk more to the recent process management changes? So Erwin, and how this impacts things. Is this a concern, or are you satisfied the team is still strong, aligned with shareholders, and incentivized correctly?
So I was at the Capital Markets Day in London recently, and I was actually able to meet with I mean, they had everyone on display. You had everyone from the CEO of Despagar, the CEO of iFood. I met the whole team, and I find that the new CEO is, he's different. Bob was a bit of a cowboy. I think Basil was also a bit maybe asleep at the wheel. You've got this new CFO who's very sharp. He's a numbers man. I think he understands how the game works. He knows what shareholders want. He knows that he's going to have to crystallize value. He's going to have to clean up head office costs. He knows he's going to have to keep on with the buyback. He's going to have to crystallize value through IPOs. He also is taking a sort of critical approach to M&A. Process, as you know, has been lax with M&A in the past. They've had a bad IRR track record. Funny enough, Delivery Hero is actually one of the bad bets they made. But Process's M&A has been a bit of a noose around the head, and he seems to be taking this more critical approach. He's more valuation grounded. He's not interested in sort of airy-fairy, sort of themes. It's where they can actually add an edge, where they can integrate, where they can, improve the culture, improve the technology. So I think he's doing the right things. I think the CEO, he likes the spotlight, but he is an operator. He is an entrepreneur. He did the time. He's got that hands-on experience in food delivery. He understands platform businesses, which works well for the rest of the strategy. Remember, they're trying to create these platform ecosystems in largely emerging markets, Latin America, Eastern Europe. So I think that if you put it all together, so I'm trying to say this has finally become a 10-cent plus. It's no longer 10-cent minus. We can actually count on Process upping the IRR, adding value on top of the 10-cent stake. So we're excited about it. We haven't seen any sort of red flags yet from the new management team. Only sort of positive leading indications that more value creation is on the way, I'd say. Nick, don't know what you think.
Yeah. No, I agree with all that. Martin, I'll send you a message about Erwin, rather than answering it here.
Well, Erwin, I can just quickly say, I think that Erwin being changed was actually positive, because I don't think that Process needed, and I'm going to choose my words very carefully here, but another sort of, another cowboy gearing the M&A strategy. And I've actually met their VP of M&A. He's a younger gentleman, but again, he's more valuation grounded. He's not just going to follow a theme at any cost. And I think that's what we need to see at Process. So I'd say positive that Erwin has left.
Okay. Then Yaku, morning Yaku. So you said, I mentioned liquidity was sucked out of SA Inc. this year. Could you briefly talk to the dynamics underlying this? So what I mean is, typically what you find in the market is, if you have these very concentrated kind of pockets of the market that performs, you have a bit of maybe FOMO, or kind of like fear of missing out on the market, and there needs to be a funder of it. So think about it. If you're running an SA equity fund where you've got 100% equity content, if you want to move the fund into something that's busy performing, there's something you need to sell. So that's what I mean. So SA Inc., from what we've spoken to other guys in the market and what we've spoken to brokers, SA Inc. seems to have been a funder for the precious metal trade that's been going on. And within that SA Inc., I'm referring to banks as well. And then you also have had the foreigners that have been net sellers of SA equities as well. It seems the only thing that will really get the foreigners interested in our market is if we see GDP growth actually picking up. Okay, then from Anonymous, what do you expect the flexible fund return range to be over the next 3 years? So we track it internally. I'll give you the number, but you always take these things with a pinch of salt, because returns don't happen in a straight line. So what we do is, we just like the process of it. We've got a 3-year RR of every holding that we have in the funds. So meaning what return per annum do we expect over the next 3 years? And then that's built up into the portfolio. And then we get to a number, what do we think the prospective returns will be? So, but it doesn't happen in a straight line. So it's, again, like take this with a pinch of salt. We don't usually give these numbers to people, but it's the flexible fund is around 17, 18%, if I recall, at the moment. Then from Asher, hi Asher, what do you think the stable coins, USDC, Circle, CRLC, especially in light of agentic agents executing transactions, do you see stable coins playing a role in corporate treasuries? I'm not going to try and answer that because I've got no idea. Laing, do you want to try and answer that?
Asher, that's a good question. Hi, Asher. But no, we're not going to comment on cryptocurrency. It's not our forte. And so, yeah, no edge.
Okay.
But Asher, we can have that conversation privately.
Okay, then, there's a comment here. It's not really a question. The energy play on AI, it's just a comment, I didn't. So should you not consider gold shares as an investment given the strong returns? Is it irresponsible to not own gold given how big it has become in the index? That's a good question. So it's 13, 14% of the index. So look, we constantly review it. The thing is though, like we kind of stick to what we do. So, our philosophy is, it doesn't mean we won't trade these things ever. So like, that's the first point. But like at core of what we do is we're looking for businesses that create value over time. We don't think that gold shares or gold necessarily meets that criteria. You get these periods and you can go look back at history where, gold has significantly outperformed and then it's followed by a significant underperformance. There's 3 kind of key cycles in the past where gold miners have made the margins that they're currently mining. 2 of those subsequently gold shares fell 80% and 50% post that. And then the other period was in the 1970s where they subsequently continued to perform. So you need to make a hell of a big call to say that they'll subsequently perform. And then not owning them given that they're big in the benchmark. Process we never owned for a number of years. And we managed to still outperform. It's only recently that we really added a position to it. So we when it comes to the benchmark, we're not looking at the benchmark and saying this share is bigger than benchmark and that's why we need to own it. That's not how we do it. We build the funds up from a clean sheet basis. So I think that covers all of it. So thank you to everyone that's attended. I think we've covered all the questions. And yeah, thank you for your time, and we'll see you at the next one.